My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Everybody hates the barbell until days like today, when it keeps your portfolio from getting obliterated and driving you bonkers. For months, I've been telling you to keep your money in a barbell, with some COVID winners like the momentum tech plays that have been soaring, and some recovery stocks that rally when we feel more confident about the future, even though they've been acting like... Today, the COVID winners got hammered, but the recovery stocks, well, they roared. Transports, travel, leisure, construction, aerospace, retail, they led the market higher. Dow surging 358 points, S&P advancing 0.27%, what a streak that's got going, and the tech-heavy Nasdaq losing 0.39%. If you own none of these winners, oh, you had a miserable day. If you followed my barbell advice, you offset your losses with some good gains from the most beaten-down parts of the market. Why is this so important? Why does it matter that you protect your portfolio against a bad day for a group that has made you a ton of money? Okay, you need to understand something about portfolio management, a skill I've spent 40 years learning that I try to teach every day. Think of this show as a continuing education course for both of us. For years, some of the smartest people in this industry have been preaching the same gospel, that it's a fool's game to manage your own money. They tell you it's impossible to consistently beat the market by picking stocks, so you should just give up and put your money in a cheap index fund. Just like, hey, don't bother. This is actually, though, a relatively new phenomenon. It only became the conventional wisdom after the dot-com bubble burst. And it's totally bogus. How do I know that? Let me put it this way. Really rich people have always tried to augment their wealth by owning some individual stocks. They never stopped. I spent years helping rich people manage their portfolios, and many of them came up with brilliant ideas. They have two eyes. They had far more good ideas than bad ones. It was a joy to brainstorm with my clients. An art collector would see flows into gold. A scientist predicted the coming of the personal computer when we were still using mainframes. A retail exec recognized the power of Gap under Mickey Drexler, put it out that if Target were spun off from the old Dayton Hudson, it would have a terrific run. All those things came true. And it's not just the rich, obviously. Anyone can do it. Individuals excelled at picking stocks in the 80s and 90s. You know, we used to call it the greatest story ever told, how the business had been democratized as more and more information became publicly available. Well, then the dot-com era sucked in a lot of people. And in a very short period of time, they lost everything. It took years to come back. Just when it seemed like individuals were finally dipping their feet back in the stock market, the Great Recession hit, cut their feet off mercilessly. Even as the market rebounded from the financial crisis, the hits kept coming. In May of 2010, we got the last straw. A flash crash that lost people trillions of dollars on paper in the span of a few minutes. And that did it. That was it. It discredited the asset class to the point that people just said, get me out. Since then, the anti-stock picking consensus has hardened. Most experts will tell you not to bother. Or they'll insult you and say not to bother. It's too hard, at least for amateurs. Professional portfolio managers who pick stocks for a living will urge you just to put your money in a mutual fund or an S&P index fund. The implication? Maybe some people can beat the market, but home gamers are too dumb. You're too ill-informed. Type of things that your mom told you never to say to people. The fact that I came out here every night and try to help you manage your own money, it's considered to be pure hubris. It's 15 years with the hubris, so maybe it stops being less pure. I don't even think you should put all your savings in individual stocks. I'm always telling you to keep your retirement money in an index fund. I surrender. Still, if you're willing to do the homework and you stay disciplined, I believe you can beat the market with your discretionary stock-picking portfolio. And I'm not just talking about the people who are smart enough to buy Sorrento or people smart enough to buy Novavax. Which brings me to today. I've said repeatedly that when a post-pandemic rebound starts looking likely, you'll wish you owned some recovery stocks, the stocks of companies that will have huge growth once we go back to normal. Problem is, we had no idea when that would happen, hence the barbell. I told you to own some recovery stocks just in case, because it would sneak up on you. If you waited for some terrific vaccine news or some sense that Congress was making progress in the stimulus negotiations, well, odds are you'd be too late. I sure didn't expect recovery stocks to roar today. No vaccine news, nothing encouraging from Washington. You'd expect the high-growth portion of the barbell, the FANG stocks, Facebook, Amazon, Apple, Netflix, and Google would be the leaders, along with fellow travelers NVIDIA and Microsoft. There were some specific analyst boosts that took up Apple, but the rest of the high-flying growth stocks got pancaked, much to the chagrin of everyone who thought the market should reflect the macro, the big picture that shows how the economy is doing right now. Not today. Instead, we had a couple positives that boosted the other end of the barbell. Positives that had nothing to do with the headlines or politics and everything to do with the companies themselves. Granular, micro. First, Marriott reported a seemingly terrible quarter. But when you dove into the conference call, what you must do, there was some good stuff in there about the nascent return of travelers. If travel's coming back, Marriott's a buy, so the stock jumped 3.5%. Sure, it's down 36% for the year, but that makes it even more enticing. Travel. Oh, let's buy American. Let's buy Delta. Oh, wait, just buy some Boeing. Then we had a hideous quarter from Royal Caribbean. Kind of obvious considering that they can't set sail. But the company announced phenomenal bookings for next year, and its stock shot up 10%. It was an astounding move. Put the two of them together, it seems like clear. Consumers are eager to travel, to take a vacation. The only thing stopping them is the pandemic. And by the way, if they just wore masks, I mean, I don't even, I hear people fly. I don't even think anything about it. They all wear masks now. There's always some naysayer who says, hey, it doesn't help. But those people are idiots. Sorry. Finally, Foot Locker, a beaten-down mall retailer, reported an incredible 18% increase in same-store sales. 18, igniting a monster rally in all things apparel, naturally including Nike, which is just such a charmed stock. But just go buy it, right? But also, just go do it. Just go buy it. But also pretty much everything else imaginable. Think about it. Foot Locker's good. What can Target and Walmart put up? Whoa! Last week, we saw this nascent rally coming when the transports took off, led by United Parcel, Carol Tomei, CEO. Today, the move expanded to FedEx and the railroads. Why not? They benefit from recovery. Travel, leisure, mall spending. At a time when people are cheering Simon Property Group for thinking about putting Amazon warehouses in vacant JCPenney and Sears stores, it's incredible to see many mall stocks with a pulse. Oh, and if you're running institutional money and you're afraid to miss the rally, well, what do? You reach for Caterpillar, moron, of which there never seems to be enough stock once you start gobbling it up. And then, you got to buy Chevron because a strong economy means an oil breakout from the 40s. If oil goes up to 43, higher. I didn't even bother to tell you what it was. Now, because there's not a ton of money coming into the market, portfolio managers have to sell something if they're going to buy something else. So they dump the COVID winners to buy Chevron and buy Caterpillar. Now, you shouldn't have to do that, though, if you follow my barbell advice. You wouldn't pay up 8 for Caterpillar like these people do, which is so pathetic. I can't believe it. It's like, as someone who traded for a living, I'm like, are you kidding me? Could you really be that obtuse? Anyway, here's the bottom line. You need to maintain a diversified portfolio with high-quality companies that may be out of favor right now so that you won't be forced to pay up for winners on days like today. For instance, in a couple more days, you'll want to own biotech. They're crushing that. I want you to stick with the barbell. Otherwise, you'll want to throw up your hands. Not just throw up, but throw up your hands. And give up on the entire asset class every time we get a rotation. Don't prove the naysayers right. You can absolutely manage your own portfolio. You just have to be disciplined about it.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.